This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
An organisation can be defined as a social arrangement which pursues collective goals, which controls its own performance, and which is a boundary separating it from its environment. Now, that might seem to be a rather large, complicated sort of definition, so let's just look at one or two of the aspects of it. First of all, it says it's a social arrangement. And this is actually a fairly modern definition of an organisation, because it recognises the idea of it being a social arrangement, that it is consists of people, and people interact, they get on with each other, or maybe they don't get on with each other. That's all part of it being a social arrangement. People have their own ambitions and hopes and preferences, and this is all part of an organisation. Before these more modern ideas came out, organisations were regarded as almost very kind of mechanistic or militaristic. You give people orders and expect them to be carried out. And nowadays things are maybe slightly different. Okay, you rather than maybe telling someone to do something, you're maybe more likely to hear something like, could you possibly? The same idea is there, but there's an area of kind of politeness. It is more likely that you would ask someone's opinion, perhaps rather than just telling them. There's probably more participation. Often necessary because things are rather more complicated nowadays, and perhaps participation is a way of gathering all the relevant information and coming to some sort of collective decision. Pursues collective goals. Very general, in many organisations the collective goal is of course profits and profit maximisation, but in other organisations, a school, the collective goals would be something to do with the education of pupils. In a hospital, the collective goal would be something to do with curing patients and so on. So goals is a very wide, potentially very wide set of targets, if you like, that the organisation could be going for. Controls its own performance. It's kind of half true, I think. If you had a company, ultimately it's going to be controlled by its shareholders, but for most of the time it would be the directors and managers who would be controlling the company on a day-to-day basis in the hope of, say, maximising profits. Of course, if they didn't come in with good results and good profits, the shareholders might sack those directors and so on. But essentially, you have some sort of structure which enables it to measure its performance, compare that to some sort of budgeted performance, and hopefully correct where there's some sort of a shortfall. And it has a boundary separating it from its environment. So we have the organisation here, we have the environment here. There's an idea of what is part of the organisation and what is not part of the organisation. This boundary we have here is what defines what's part of us and what's part of something else, really, part of the environment. And organisations tend to take inputs here. So in a manufacturing company, the inputs could be power, it could be steel, wood, etc. And the outputs coming out here with some sort of manufactured product. Doesn't have to be like that. If this was a firm of accountants, the inputs would essentially be information taken from clients' financial statements and accounts and so on, and the output might be a completed audit of some sort. But organisations exist to do some sort of processing normally. If they didn't have any inputs and didn't have any outputs, it becomes rather difficult to know what the organisation is for and indeed how it's going to sustain itself. Types of organisation you just need to think about. We have commercial or profit-seeking organisations. More or less any business is this, and we recognise this very easily. But then there's a very large sector called the not-for-profit sector. This includes many government departments. local government departments, it'll include many charities and so on. They have goals other than profit maximization. They're called non-profit seeking or not-for-profit organizations. You have public sector, and public sector organizations are owned by the government. Note that a public sector organization is often not-for-profit, so the Defense Department in some countries, the health departments and so on are not profit-seeking, but they can also be profit-seeking. So I think I said when we were looking at sources of income from a government, one was the privatization of state industries. So at one point British Airways was owned by the government. That didn't mean that that public sector airline was not supposed to be profit-seeking. So public sector is not the same as not-for-profit. You have non-governmental organizations. Non-governmental organizations, they might get finance from the government, but they are not part of the government and they do not take orders from the government. So examples of non-governmental organizations, you can have Greenpeace. You can have Oxfam. Some of these large international type of organizations known as non-governmental organizations. They're quite like charities in many ways, but strictly, certainly in the UK, they are tend to be separate from charities. A charity is something which is registered in the UK with the Charities Commission, but they exist. They can be very large and so on, and they tend to be international in their remit. And then you have cooperatives. Cooperatives is the feeling in a cooperative is kind of a mutual society. So you can have cooperatives of farmers who, let's say they were growing coffee. They can have a cooperative where the coffee from all of the farms, of course they would weigh it, but it's all basically combined, and then it is sold as one lot. And because they're selling a lot of coffee and so on, perhaps their negotiations go rather better than it would with several small farmers going there individually, and one being played off against the other. And it is for their kind of mutual benefits. They all own the cooperative, they all share in its profits, if indeed it is a profit-seeking cooperative. By far the commonest form of commercial organisation is a company. You can have sole traders, you can have partnerships, but once something gets a decent size, it becomes a company. And the great thing about a company is that it will have limited liability. This means that if the company fails, if it runs out of money and it owes its suppliers money still, the company's liability is without end. All the company's assets can be sold to try and pay off these creditors. The limited liability here is for the shareholders. So if I have a company and the company goes bust and my suppliers are still owed money, they can't come after me and seize my house or seize my savings and so on. My liability is limited, but the company's liability is unlimited. The commonest form of a shareholder is an equity shareholder. To become an equity shareholder, you can either buy shares that are already in existence, or at the start of a company's life, you can pay in capital, subscribe capital, and get shares in return. This is your part ownership of a company. And what you are entitled to is dividends, usually an annual payout, if profits are made and if the directors think the company can afford dividends. These dividends will go up and down, therefore, depending on how successful the company is. You can vote at the company's annual general meeting. You can decide maybe to change the directors or some other decisions are made there. And of course, you can then sell your shares. And what you hope is you buy the shares at $5 each, and maybe 3 years later you can sell them at $7 each. So what you're liable to get by way of investing in a company are dividends. This is income to you. And what you hope to get when you sell your shares is what's called a capital gain. The share value goes up. Of course, there's no guarantee in any of this. There's no guarantee you're going to get any dividends. And of course, many people buy shares and see them go down in value. So you may actually get a capital loss. This means that effectively equity shareholders suffer some risk. They don't have the promise of any income, and they don't have the promise that they will get their money back that they put into the company. And if the company goes into liquidation, first of all you pay off the creditors, the suppliers and so on, and the banks who may have made loans, and right at the bottom of the list for payout is going to be these equity shareholders. So these tend to be here high risk, but they hold the possibility for high return. You could lose everything if the company goes into liquidation, but of course if the company is successful and its share price whizzes up, then you can become very rich indeed very quickly. Company finance, we've talked about equity shareholders or shareholders paying in money to finance the company. But there are really two sorts. There is finance is a mix of share capital, retained earnings and loans. And the share capital and the retained earnings, this tends to be known as the equity of the company. Equity. So equity shares in a way own the retained profits of the company. The other place you can go is to the bank or to an individual and ask to borrow money. What's the significance of borrowing money? Well, if you have a loan, then the interest has to be paid. Dividends didn't have to be paid. That was up to the discretion of the directors. Interest has to be paid if the loan isn't to default. So you're guaranteed your 5% or whatever the loan rate is going to be. Also, the loans tend to be secured. This means that there's a mortgage. So if the bank lends you money, the bank essentially has an agreement to say, if you don't pay me the interest, or don't pay me the loan back, then I can grab the company premises and I can sell that and reimburse myself out of that. And they also get tax relief. The interest paid enjoys tax relief. So in other words, the interest paid is reduced by the 20, 25, 30%, whatever the corporation tax is. And all of this means that loans are relatively cheap. You're more or less guaranteed to get the interest. If the company gets into trouble, you'll probably get your money back. You're certainly well up the list of paying back. And if your loan is secured, it has got a mortgage, if you like, on some decent asset of the company, then you're probably going to get the principal of the loan back as well. And also the company enjoys tax relief. So loans are relatively cheap for a company to issue. The cash earned by a company is therefore spent or used in three ways. You can use the profits, so the net cash and net profits, if you like, to pay dividends. You use the net profits to pay interest. So first you pay the interest, and then if there's any cash left, you could pay the dividends. But also what you can do is you can decide how much money you have left. Do I use the money left after my interest to pay dividends? Or do I use the money, keep it in the company, and invest in more plant and machinery? In a way, the leakage from the company is the dividends and the interest. This is what the company has to pay every year to keep the shareholders happy and to keep the bank happy. And the amounts of dividend and interest which are paid to the suppliers of capital here is known as a cost of capital. So it might be if you want to raise shares, you might have to promise your shareholders like 20%. So if you pay in 1,000, then you have to kind of hold out the opportunity, if you like, to maybe get dividends of 200 per annum. It's not guaranteed, of course, but you have to almost dangle this bait in front of them. If you are raising a loan from a bank, then the bank might say, well, I expect 7% per annum. And those two together, the kind of 20% of maybe profits going to your shareholders and the 7% of the loan going to the bankers, those outflows together are going to be representing or going to be making up the cost of capital, which is basically how much you can raise for what annual payment. The lower the cost of capital, the better, because it means you're going to have more money left over to invest in the company, to buy new assets, and to allow the company to grow. Companies' performance. Well, we need to measure that. Shareholders want to measure it to see if they want to invest. Banks want to measure it to see if it looks like a reasonable place to be lending money to. And the first example we have here is a return on capital employed. There are worked examples in your notes. What you must know is what is the top line, what is the bottom line. And what we have here is the operating profit before tax and interest. So it is before interest, because interest is not an expense. Interest is a reward to the suppliers of capital. And it is before tax, because you can't really control tax. That is something of the government. So this is a bit like an interest rate, really. This is the principal. This is the amount which has been put in, invested, and this is the amount here which is being paid out. The capital employed is the share capital plus it is retained earnings together. These two here make up the equity, plus it is the long-term loan capital. These are the sources of finance. This is what's been invested long-term in the company. Initial share capital plus retained profits plus long-term loans. This is what the company is making its money out of, and the top line is saying how much money it is making for that investment. Return on equity, a slightly narrower definition here. This is the operating profit after interest, because we want to see what is left for the equity shareholders. So basically, if you're paying stuff out, you have the operating profit. So it's basically sales less cost of sales and so on. And then you'd have less the interest. So this is the profit after interest. And then you'd have your tax. And then you can have the dividends. And then this is down here, this is going to be retained. So you make a certain amount of money. The first thing you have to do is to pay the interest. And then what you have to do is to pay the tax. And then if there's any left, what you can do is you can pay dividends out of that. And you're left with your retained profits down there. So return on equity is saying how much is potentially available to the equity shareholders. Again, it is before tax, because we can't control the tax. It's defined as this here. But it has to be after interest, because the lenders here get their slice of the action first, and the equity shareholders have to make do with what comes next. And on the bottom line, you have shareholders' equity. And remember what that is. It is the share capital plus it is the retained profits. So share capital plus retained profits. Sometimes it might be called share capital plus reserves. Retained profits, probably a better explanation. Earnings per share. Earnings per share is looking at the profits after interest, basically dividing and after tax, and dividing by the number of equity shares. Dividends are slightly arbitrary. You could look at dividends per share, but dividends per share could be low one year and high the next year, simply because of a director's decision. What we're doing is we're saying you have your profits, you pay off what is due to the suppliers of loan capital, you pay the interest, you pay your tax. There's something called preference shares I'll talk about in a moment. And what's left after all of that is cash, really, or potential cash, which is available to your shareholders, and you get an earnings per share. The higher the better. The higher the earnings per share, the better the company is doing. Preference shares are a fairly minority sort of shares here. They could be, for example, described as something like 8% preference shares. 8% means you get 8% of what's called the share's par value. So if these were 8% preference shares at 50 cents each here, you'll be getting 4 cents per annum, because it's 8% of 50 cents is 4 cents. And this is a fixed dividend. Okay, the equity dividend goes up and down, but the preference share dividend is fixed. It is defined by the description of the share. Usually preference shareholders don't get any voting rights, and usually the value of preference shares is very static. Okay, so in a way what you're doing is you are trading in the more or less certainty, not quite certainty, but more or less certainty of getting 8% per annum on your preference shares. So for that certainty, however, what you lose out on is the chance of your shares increasing vastly in value. The equity shareholder is having their dividends go up and down, but what they get in kind of compensation for that uncertainty is the chance that their share value is going to get rocketed away if the company is very successful. One of the big pressures, particularly for listed companies, that's companies quoted on the stock exchange, is huge pressure to perform every year. Every year the profits must get better. And very often the financial press says, I think the profits this year should be 150 million and so on. And if the profits don't come up to 150 million and profits are only 145 million, then there can be criticism, particularly through financial press, analysts and so on, about the company's performance. And directors may, of course, lose their jobs if the company's performance doesn't seem to be getting better and better and better, nice and smoothly each year. That's the short run here. However, shareholders tend to want longer term good performance. They want to know that this investment, maybe they're making it for their pensions, is going to keep growing nicely for 20 years. And there's a real kind of conflict in here between a company doing well in the short run and a company doing well in the long run. Let's say I was the managing director of a company and I thought my profits were going to be disappointing. What I could do is I could reduce research and development expenditure. So research and development expenditure is nearly always a current expense. So if I reduce research and development expenditure, then of course my profits will go up for that year. I could reduce training. I could reduce kind of repairs. I could not repaint. I could not repair windows quickly enough, and so on. There, all of these would reduce this year's expenses and increase this year's profits, and that might be enough to let me perform well in the short run. But maybe 2 or 3 years later, think what's going to happen. I cut my research and development, so I've got no new products. I've cut my training, so my employees get fed up and they move away because they're not feeling they're getting advancement and training and not growing in their job and so on. And you know what happens if you don't do routine repairs on your cars, routine maintenance on your car. If you don't do routine maintenance on the car, what tends to happen is you get a very expensive breakdown later, and you're out much more money in a few years' time than you would have been. And of course, this is setting up good short-run performance, but in the long run, it can be devastating for performance. But maybe the directors don't mind. Maybe the director can say, look, I've increased profits for 2 years, and the director can use that record to get a better job somewhere else, leaving this kind of wreck of a company behind that hasn't got new products, hasn't got staff, and all its machines are breaking down very expensively. Therefore, maybe instead of looking at just this year's profit, which is very manipulatable here, what we should use to assess company performance is a technique or techniques which try to take account of all the cash flows, all the effects in the future. We don't need to get into it in great difficulty, in great deepness rather, but a technique like net present value calculations looks at cash flows coming in as far as you can see them, as far as you're able to estimate them. And if it was done properly, they could see a kind of positive reduction in this year's expenses, be boosting this year's cash, but then it should follow it through and say, well, in 3 years' time, I won't have a new product, my revenue will be falling off a cliff, and it should encourage them to make these longer-term decisions. Stakeholders. The term stakeholder refers to anyone who is really affected by the organisation, in some way touched by the organisation. We have potentially 3 types of stakeholder. You have internal stakeholders. Examples here would be employees, directors. In the company the whole time, so to speak. Definitely internal. Connected stakeholders is really anyone who has some other sort of contract here. So with connected stakeholders you can have customers, suppliers, and indeed shareholders. So they're not kind of intimately involved with the company as an internal stakeholder has, but they've got some sort of contractual or legal relationship with the company. And then you have external stakeholders who are affected by what the company does, but don't really have much contractual rights in here. You have, for example, the local population. The government is usually regarded as an external stakeholder as well. It is, of course, interested in how companies do because of employment levels and so on. Interested maybe what a company does because it's going to affect the balance of trade and so on. So these 3 divisions exist, although they are in a way fairly useless, this categorization. It doesn't go much further than knowing they exist, really. What is more interesting is understanding what the issue of stakeholders is about, and this is that they're usually in some sort of conflict. So you think of your shareholders. Your shareholder here wants profit up. But the employees, of course, want wages up. And the more wages you give to your employees, then the lower the profit is going to be for the shareholders. There's a kind of a tension there which is going to come around every time there's a wage negotiation. It could be the local population. If the company was an airport, the local population wants takeoffs and landings to stop at 11 at night. But perhaps the managers would like 24-hour operation of the airport so they can get more profits and so on. And there's nearly always this conflict between stakeholders, and managers have to try to resolve it. And one of the things they can do is to make a kind of judgment about almost how important a stakeholder is. And what they do is you can look at the power of the stakeholder, and you look here at the level of interest. A level of interest really is saying, are they kind of very, very passive, a low level of interest, or are they going to be really quite active? High level of interest. And the people you need to watch are these. They have the power, and my goodness me, they're going to exercise that power. So there have been airlines around where the flight attendants were key players. If the flight attendants go and strike, you can't fly the aeroplane. And they had a kind of culture of militancy, very, very, very unionized and so on, and were quite happy to go and strike at a drop of a hat. And these people ended up with really, really very good terms and conditions, very high salaries. Along here, they keep satisfied. These people have power, but relatively reluctant to use it, perhaps for ethical or professional reasons. Good example there, nurses in hospitals. So if you don't have nurses, the hospital can't really work. But for humanitarian, ethical, professional reasons, very unusual for nurses to go and strike. And these people, you just give them enough to keep them on side. They will get less of a pay rise, if you like, than the key players. We've got keep informed, sadly self-delusional. They have no power, but they're very, very active, make a lot of noise, but can't do very much. You keep them informed to be polite, really. And unfortunately, you have at the back here minimal effort, which is a nice way of saying ignore them. They don't have any power. They're very passive anyway. These unfortunate people are going to be coming right at the end of the queue when it comes to terms and conditions and getting what they want, and so on. And management has to understand these forces and kind of come to compromises between these stakeholders that most of them can live with. Now, the principal agent problem we need to deal with here. We nearly got onto it in here because we talked in the stakeholders here. We talked about directors. We talked about shareholders. And shareholders in this are the principals. They have the ultimate ownership of the company, and in an annual general meeting, they have got ultimate power in the company. And the directors are the agents. And it is the legal duty of an agent to act in the best interests of your principal. In other words, the directors should be acting in a way which maximizes the wealth of the shareholders. However, in large companies, the shareholders are not at the company every day. They go along once a year. And it is the directors who have got day-to-day control of the company. And there were abuses of this. What was found was that directors would be awarding themselves perhaps large pay rises, going on kind of first-class air travel, giving themselves nice bonuses, giving themselves nice cars and so on. So the day-to-day actions of the directors were not necessarily in the best interests of the shareholders. And this in a way came to a head with some very large financial scandals where the directors had kind of been pursuing their own interests and really letting the shareholders stand very large losses when the company went into liquidation. So there's this director-shareholder, this principal agents problem, as it's called, and to get round this, to get over this sort of a problem, most countries brought into existence some sort of what's called basically a corporate governance code of some sort, which tries to bring more control over what the directors are doing. In the UK, it's called the UK Corporate Governance Code. In the United States, there's something called the Sarbanes-Oxley Act, which is slightly different. Sarbanes-Oxley Act is very, very procedural. People have to sign stuff off, and if they don't sign it off properly or negligently, they can go to jail for it. In the UK, it is much more a principles-based code, and it relates in particular to listed companies. In other words, companies on the stock exchange, and the code is enforced by the stock exchange. In America, the code is law. In the UK, the code is not law, but companies which are listed, are required to comply with the code, or else have a very good explanation why they haven't. So what does this say? Well, the first thing it said is that the Chief Executive Officer, Managing Director if you like, and the Chairman of the Board should be separate. Because what was found in these big scandals was you had a very powerful, charismatic, almost bullying person at the top, and none of the other directors would say boo to this person. They would just do what this person said without proper consideration. So what we have now, instead of having this one person at the top, it's separated into the Chief Executive Officer and the Chairman. It's kind of trying to split their power, divide their power, spread their power into two people. It invented something called non-executive directors. These are directors who sit on the board, who've got a full vote and so on, but they are not there running the company on a day-to-day basis. Therefore, they are more likely to be impartial. They're more likely to criticize maybe what's happened in the company. And they should be roughly 50-50 to the executive. The executive directors do the work. The non-executives come to the board and they can give advice, they can warn people, they can ask probing questions about what the board is doing. And again, we're getting this splitting. And one of the things about these non-executive directors is they have to get a fixed fee, not related to profit. Because one of the things that the executive directors would do is maybe make a bit of a gamble in the hope the company made a big profit, in which case they might get a big bonus. And this kind of moved them maybe towards a risk profile which was not appropriate. The directors used to award themselves big bonuses. Now there is a remuneration committee composed of non-executive directors which looks after the remuneration of the directors. There's a nomination committee which is looking after new replacement directors. Because the old abuse was, we need another director. I have a good friend, or I have a golfing partner or something. This person would be just splendid as a director. And you had this rather kind of closed shop of directors. And that's silly, because if you were going out and appointing an IT manager, you'd advertise the post, you'd have your 30 applications, you'd whittle it down to 5 people, you'd interview them, and you give the job to the best person. Why should it be any different when appointing a director? There is an audit committee, again non-executive directors, which is going to liaise with the auditors. Without the audit committee, the external auditors and indeed the internal auditors would tend to be talking to the finance director, liaising through the finance director. But of course it is the finance director who is responsible for the accounting department and producing the financial statements. So you could be complaining to the finance director about something the finance director had done, and the finance director would maybe not raise it at the board. Now, the audit committee, non-executive directors, much more impartial and could raise important issues. Maybe a fraud was discovered, raise it at the board meetings. Directors are specifically responsible for the long-term strategy of the company. Remember, we had the long-term, short-term conflict. Corporate governance says to directors, look at the long-term strategy of the company. What are you going to be doing in 5 years? What's the company going to be trading in? What countries you're going to be in, what's the competition going to be like in 5 years, and so on. And finally, it is the directors who are responsible for designing and implementing a good system of internal control. If you don't have a good system of internal control, how could you possibly have any confidence that you are managing the company properly? If you couldn't be confident that expenses being recorded will be recorded correctly, then you've no idea where the money is going. If you don't safeguard the assets, insist that valuable inventory or cash and so on is locked away at night, how can you possibly be said to be properly managing the company?